Good evening, Pradeep sir, and good morning to all.
Yes, good morning.
Sir, now onwards, we are on live, YouTube live now, going on.
Yeah, you already made it live.
Yes, sir, started.
But
So,
we need to wait for people. Shall we start the class?
the link is coming, sir. Link we are generating, that's why.
Okay.
So we have to share this link to all. So in advance, we have to give, sir.
Okay,
So
no
friends,
problem.
those who are in the meeting room, please have a chat with Pradeep Kulkarni sir, our senior most faculty, and Chief Manager from Union Bank of India. So you can utilize the time. Within 10 minutes, other members also join. Yes, sir, over to you, sir.
Hello. Good morning, everybody. Good morning, everybody. Can I get a response? Am I audible to you? Hello? Audio, video is okay? Hello?
Yeah, audio, video is okay, sir.
Okay, good. So
they can unmute now. You can unmute now and chat.
Yeah, you can unmute and talk to me. I think this is a revision session, and therefore we will not go everything in detail, but at the same time, we'll try as our level best to get clarified your doubts or any sort of queries. But the focus is absolutely exam oriented. Therefore, please be attentive throughout the session. And at the end of the session, we will dedicate 10 to 15 minutes for the purpose of doubts clarification. Okay. And as far as possible today, during this session, I would try to finish off the areas which are prescribed in module 1, that is module A of Principles and Practice of Banking. As such, there are many areas which are overlapping in A and B, and therefore the program is scheduled as the Principles and Practice of Banking, module A as well as module B. Therefore, sometimes another topic also, if it is discussed, that will also be highly useful to you. Now, there are two questions I am asking you, my friends, and I would like your responses in the form of thumbs up. Okay, you need not have to unmute and talk to me. You can give me the signal. Number one, whether this speed is okay to you all, or do you want me to be further slow? The speed is fine, Kavya. Thank you. One thumbs up I got. The rest of the people, if I get a thumbs up, I'll be very happy. Okay. Second is, in addition to this speed, whether the pronunciation and the way in which I am talking, is it clear to you? Nice. Thank you. So I'll share the presentation. Now, there are 2-3 things I'm telling you. I'll share the presentation to you, but don't expect that entire presentation, whatever is stated there in the slide, will be discussed. My focus is to talk to you only the exam-wise important aspects stated in that particular slide. Hope my point is clear. Okay. So let me start sharing the screen to you. Okay. Welcome you all once again. Let me begin the session. I think candidates will come joining. In between, we can begin the session. Now, before I really start the session on the Indian financial system, can I know that do you have any specific points to get clarified in this session? If those are there, then I can make a note of them and I'll try ensuring that those points are covered today itself. Can I have any specific requirement of the participants from this session which is specifically planned for you? Hello?
Related to Garnishi order, sir.
Garnishi order. Good. Okay. Next.
And assignment, when we'll use assignment, lean,
Garnishi order assignment. Okay. I have noted. What's your good name?
Anuradha, sir.
Anuradha, no issue. Okay. Hello?
NPA, sir.
NPA. Okay, that is known as asset classification. What is that? Asset classification and income recognition. Okay,
Sir,
income recognition and asset
factors-
classification norm definitely will be discussed. Hello?
Sir, factors and forfeiting.
Factoring and forfeiting, definitely. Yes, good. Okay. Next.
The tier 1 and
And,
tier 2 capital.
Okay, tier
Basal.
1 and tier 2 capital, that is Basal 2-3. Basal 2-3, that is tier 1 and tier 2 capital. Okay, next.
And LC also, sir, different name, bank names we will use, na, sir.
LCs.
Negotiating,
Okay,
advancing,
parties to
confirming.
LC. Okay.
Yes, sir.
LC parties and type of LCs. Okay, good. Then anything you require, please tell me. I'm noting them. I'll see to it that today itself these aspects will be discussed. Anything. Class is open to you. You can even put them in chat also. No problem. You can put them in chat also. I'll take a chat copy and I'll just record in my one of the file. You can put in the chat box. Okay. So nothing is coming up. It seems that whatever way the session is being dealt will be fine for rest of the people. Don't worry. Okay. Biju, shall I begin now class as usual?
Sir, after 3 minutes, sir, because some more joining. 6 o'clock.
Okay.
Sir,
Okay.
2-3 minutes, sir.
Okay, still time is there. Okay,
Yes, sir.
so this time can be utilized by other participants to sort out anything else. Yeah.
Sir, working capital problems, insurance problems.
Insurance and working capital. Okay. Then
Different type of guarantees is this, sir.
guarantees. Okay. Bank guarantee. Okay. Then
Sir, in case of
And
policy
that
rates,
relationship between the banker and customer will be there, na,
what is
sir.
that? Banker customer relationship. Okay. Yeah. Anything else?
ASBA.
Okay. ASBA. Okay, good. ASBA. Okay, then
sir, in case of policy rates, sir.
nice. Policy rates. Okay, RBI. Okay. Then
Sir, with respect to the
Priority sector.
exams,
tell me. With
so
respect
which
to the
policy
exam.
rates we have to keep in mind, sir? The previous ones or the which is the recent one, sir?
See, one thing you have to remember that we always have a deadline. Okay, means updation up to a particular period only is considered for your exam. Okay, and mostly for June month examination, anything which has happened in the banking related activity up to December is expected to be answered. Okay, are you getting me? So that
Yes,
is
sir.
what is a deadline. Okay, that is what the benchmark. Okay, but it doesn't mean that in case there is a rate given in the current way and it is asked, or in reference to a particular date it is asked. For example, October 2021. So it means they are expecting you to answer only that particular, that is December related rate, because any change has happened in the policy rates and that has happened mostly after October 2021 only. Okay, prior to that, almost the rate was stagnant with regard to repo rate, with regard to your CRR. Okay, CRR enhancement, repo rate enhancement, MSF rate enhancement, everything has happened only during these particular 4 or 5 months. Are you getting me? So you need not have to worry. The examination paper will not try to make you unnecessarily confused with regard to this particular aspect. Okay, more so the rate will be asked to you in such a manner that the repo rate announcement by the Reserve Bank of India, repo is reduced, then what is the impact? That is the way questions will be asked, rather than asking you the straight rate, particular rate in reference. Is it clear?
Yes, sir.
Okay.
Yes, sir.
Don't worry. Okay. Then But any other doubt? Because that is what is your deadline, because there are many things which have undergone change. Everything as of today is not expected. Okay. Everything as of December 2021 is expected to be answered.
Sir, in case if they
Okay.
ask what is
What is?
the current CRR percentage, then
Current CRR, and out of them there is no answer for today's. Then what does it expects? It expects
previous
that
one.
only. Are you getting me?
Okay.
That is the way
Okay.
it will be asked. Okay.
Fine,
Okay.
sir. Thank you.
Then, yeah, good. Don't worry. Okay.
And the operating
Hope that
cycle
3
methods
minutes
also
are up.
we'll discuss.
Hello.
Sir,
Operating methods, sir. Operating
Priority
methods.
sector. Okay, definitely. Okay, whatever you have asked, I don't find anything which is not being planned by me. What I'll try doing, no, the other aspects which I have planned, I'll try reducing focus on them, and I'll try give more emphasis on what you asked. Okay, don't worry, because there are in a module A of Indian financial system, there are many things which can be elaborately discussed, or there will be a lot of discussion can happen. We will try avoiding that sort of discussion because we are exam oriented session. Okay, let me begin the session for today. Okay, now first of all, this Indian financial system, when the module A is titled, what exactly Indian financial system means? Indian financial system is nothing but a system in which the people who have got surplus money money can be mobilized for the purpose of giving it to the people where that is needed, and that need may be either investment purpose or consumption purpose. To be precisely, mobilization of capital from various surplus sectors of the economy, and that need to be allocated and distributed to needy sectors, which will be transformed into savings, into investment and consumption. This is the simple understanding of Indian financial system. And Indian financial system, it includes what? It includes many things. It includes, see, for example, a system is always made up of structures, and the structure of Indian financial system has got 4 important pillars, and those pillars are: number 1 is a financial intermediary, number 2 is a financial market, number 3 is a financial instrument, and number 4 is financial services. And these 4 pillars are being supervised, regulated, managed by whom? By these kind of regulators. And who are all the regulators? You can see here. Reserve Bank of India is the regulating authority for banking and non-banking finance. SEBI is a regulating authority for capital market. IRDA is a regulating authority for insurance, and therefore it is titled as Insurance Regulatory Development Authority. PFRDA is Pension Funds Regulatory Authority. So NABARD and NHB, they are no more regulators. They play only supervisory role. Whereas now even the cooperative banks are also under the regulation of Reserve Bank of India. And here is a IBBI, that Insolvency and Bankruptcy Board of India. Insolvency and Bankruptcy Board of India is the regulator for various utilities of insolvency. Okay, Insolvency and Bankruptcy Code also has got 4 different pillars. So for them, regulations are provided by IBBI. And over and above, it is under Ministry of Finance. Okay, let us first, and please understand, in today's topic, we are discussing all the 4 pillars. All the 4 pillars. Number 1, who are all the financial intermediaries? What is this financial market all about? Which are all the different instruments are being traded in this financial market? And which are all sort of financial service and support providers? And you can see here under intermediation. What is mean by intermediation? There is someone who has got money and there is someone who needs money. This can be exchanged directly, but it doesn't happen. It happens through an intermediary. Bank is one such intermediary. Whereas there is a NBFC, non-banking finance companies, mutual funds, cooperative societies, insurance companies, all these people also perform the same role of financial intermediation. Second thing, when mutual funds, insurance companies, pension funds always have got surplus money with them, what to do with that? Then for that, they definitely in search of the organizations who are in need of money. And that exchange of money between two different intermediaries happens in the financial market. And this financial market comprises of money market, capital market, forex market, and the credit market or debt market. And we will be discussing very quickly about all of them. Okay, and how this market works, which are all the different instruments they are being put to use in this market. They are Treasury Bill, dated securities, bonds, certificate of deposit, commercial paper, shares, debentures, bank deposits. All these are the instruments. And to run these three things, there is a support required. And the support in the form of credit information companies, credit rating agency, DICGC, CGT-MSC, NCGTC, CERSI, credit monitoring institutions, that is Rural Infrastructure Development Fund, Payment Infrastructure Development Fund. All these are also supporting activities for functioning of financial system. Hope this brief background about Indian financial system gives you clarity. What is that is covered today's session. Can I move further? Is it okay with you all? Shall I move? Can I get some symbol? Okay.
Yes, sir.
Good.
Yes, sir.
Thank
Yes, sir.
you. Thank you. Now let us start with, first of all, in the financial intermediaries, very first intermediaries are banks. And let us try very quickly capturing about banks. You all are bankers. And therefore, let us try understanding very quickly how many type of banks are there in our country. First of all, there are two set of banks, that is a development bank and the commercial bank. Development bank and the commercial bank. Now, development banks perform what job? They don't involve themselves into any commercial activity related thing, but rather their focus is on developing a particular sector, such as agriculture, that is an NABARD, international trade, there is a Exim Bank, small and medium enterprises, there is SIDBI, housing, there is National Housing Bank. Reserve Bank of India is an overall development bank for all these sectors which are connected to one another. Okay, so that's the way these are all development banks. Okay, and then in addition to these development banks, there are commercial banks and there are cooperative banks. There are commercial banks and cooperative banks. The commercial banks are further categorized into a scheduled and non-scheduled. What is mean by scheduled bank? Exam question. Scheduled bank means what? Scheduled banks
Follows
means
the
a
second
bank.
schedule.
Very good. Second schedule of which act?
RBI.
Reserve Bank of India Act 1934. Okay, in exam, second schedule of banking regulation, second schedule of Reserve Bank of India Act. You have to remember the bank whose name is included in the second schedule of RBI Act 1934 is known as scheduled bank. Now, these scheduled banks are commercial banks as well as cooperative banks. When it comes to the state cooperative or the urban cooperative bank, the urban cooperative banks are known as primary cooperative banks. It is not that all primary cooperative banks are part of the scheduled banks. Only selected banks are only scheduled. For example, the total cooperative banks in our country are, you can see here, 54 plus 1,528. So these many number of banks are there. Out of them, only 54 are scheduled. Okay, whereas 1,500 plus banks are non-scheduled banks. Now, to get scheduled a cooperative bank, there is a criteria, and that criteria is that the demand and time liability is 750 crore. Exam question you have to remember. Oh, then for a primary cooperative bank to get included in the second schedule, one requirement is demand and time liabilities must be 750 crore. Then capital adequacy ratio 12% and gross NPA is below 5%. If these criteria is met, and then they have to comply with CRR guidelines, then only their name is getting included into second schedule. In addition to them, there are all other banks which are there, such as regional rural bank, such as small finance bank, such as the public sector banks, such as private sector banks, such as foreign banks are already included in the second schedule. Okay, so scheduled commercial banks comprises of the, first of all, public sector banks and the private sector banks. So public sector banks in India are how many? How many?
26, sir. 26.
So actually, no 26. Now, State Bank of India plus Nationalized Bank 12. And one more bank gets added, that is known as Jammu and Kashmir Bank. Okay. Now, these are the 13. And then old generation private banks, that is domestic private banks, are 12. New generation 7 plus 2, 9. So 12 plus 9, 21. 21 are domestic private banks. Foreign banks are approximately around 43, 45 are the foreign banks. Okay. Regional rural banks are 43. Local area banks are 3. Small finance bank are 12. Payment banks are 6. And as well as the state cooperative banks are 31. And primary cooperative banks 54 are scheduled and 1,528 are non-scheduled. And this is what are the number of banks operating in our country. In addition to them, there are NBFCs. In addition to the banks and NBFCs, there are mutual funds. Okay. Now, out of them, we will try discussing something which is critically important for exam, that is differentiated bank, that is payment bank and small finance bank. The minimum capital requirement for small finance bank is 200 crore. Minimum capital requirement for payment bank is 100 crore. The kind of business which is permitted for payment bank is only they can accept demand deposit. Payment bank can accept only demand deposit. That is, demand deposit means current account and saving account. Whereas small finance bank, they can accept all sort of deposits and there is no cap. Payment bank can accept demand deposit not more than 1 lakh from one customer. Okay. In addition to that, there are no priority sector target to payment bank. Whereas for small finance bank, the priority sector target is 75% of their A and B, C. Hope these 3 points are clear. Exam point of view, very, very important.
Sir.
Very important exam point of view.
So for small finance bank, they increased from 200 to 300 crores, sir.
From originally it was 100, increased to 200 crores. Okay. And likely to get increased to 300 crore. Okay.
Okay. Now still 200 only, yes, sir?
200.
Okay.
Okay. Now, in addition to it, there is a proposal to establish 2 more differentiated banks. Those are wholesale and long-term finance bank as well as a custodian bank. Like these 2 different banks are proposed to be getting established. This is for the last 3 years, that is under proposal. In addition to this, exam point of view, again an important point comes. This DSIBs means what? Domestic systemically important bank. What is that? Systemically. Systemically, not systematically. Domestic, systemically important banks. That DSIBs as on today in our India are State Bank of India out of a public sector and private sector ICICI Bank and HDFC Bank. Okay? Not connected. I did not understand. Hello? Anyway, someone is asking me, not connected. I don't understand exactly what exactly he means. So what is this domestically, systemically important banks? These banks, since they carry a sizable amount of business and also their presence abroad is also high, so therefore their collapse is likely to create impact on the entire Indian financial system. Therefore, there is a special focus on them. And as such, the capital requirement for these banks is little bit high. For example, common equity tier 1 capital, they have to have 60.60% high. And then for HDFC and ICICI Bank, 0.20%. So that much higher common equity tier 1 capital these banks need to maintain. And there is one more bank which already started working, and that is a bad bank. What is a bad bank? Bad bank is in talk right from last year budget onwards. In the last year budget itself that was proposed, it was supposed to start functioning from 31st March itself, but unfortunately bit delayed, but it already started working. What is a bad bank? Bad bank is nothing but this India Debt Resolution Company Limited. This IDRCL is a AMC of National Asset Reconstruction Company, and this will work as a bad bank, which will try buying the NPAs of the banks at a discount, and it will provide money to the banks so that the bank get money and their NPAs get reduced, and that NPA along with the securities will be taken over by India Debt Resolution Company. Okay, so this is what is a job of bad bank, and banks have already identified which asset need to be transferred to bad bank. And in addition to them, there are regulators. Now bank, who is a regulator? Bank and NBFC, RBI. Housing finance companies, also RBI. Earlier it was NHB, now role is taken over by Reserve Bank of India. Insurance companies, who is a regulator?
IRDA.
IRDA. Okay, mutual fund, who is a regulator?
DRP.
SEBI.
SEBI.
Okay, pension fund, who is the regulator?
PFRDA.
PFRDA. And under IBC 2016, the regulator is IBBI, Insolvency and Bankruptcy Board of India. I'm moving further. Okay, second point is a financial market. After understanding the financial intermediaries, about them, only about the bank, let us move further. And that don't worry that about other financial intermediaries also we will be discussing, but we will be discussing at the fag end of the topic. Okay, as exam wise also that is not so critical, therefore we have kept little bit ahead of it. Then as far as financial market concerned, capital market, money market, foreign exchange market and credit market. Out of them, money market is a critical to understand, that is call money, notice money, term money, treasury bills, CD, CP, intercorporate deposits and repos. So these are all the exam point of view very, very important. Shares, debentures, as some of you have asked, ASBA, then book building, there are few terms. Those terms only if we understand, that is more than sufficient for exam. Then this as far as bond market or credit market, government securities, bonds, gilt-edged securities, financial institution bonds, PSU bonds, corporate bond, zero coupon bonds, etc. are part of debt market. Whereas foreign exchange market, what is foreign exchange market? What is LIBOR? How the exchange rate, alternate rate, then SWIFT, then export import related few things. This is what is a yeah. Hello. Anything you wanted to ask? Hello. I'm sorry, I think some confusion. Okay, anyway. First of all, let us discuss the money market. What is money market? The market where actually it is being facilitating lending and borrowing of funds between banks and the entities which are like primary dealers. Means those participants who participate in the money market either for the purpose of investment or for the purpose of borrowing. Is it clear? Now, this borrowing or financing happens as per certain directives given by the Reserve Bank of India. And for example, a bank is in need of money. Why does the bank needs money? That is the question. Why at all bank does require money? Already bankers have deposits, no? Then why do the bank require money? Because as you all know, you are a practical banker, you know pretty well, you have taken money in the form of demand deposit as well as the term deposits. So there are a lot of balances available in current account and saving bank account. And the current account and saving bank account balances are available to the customer as and when he wants. Whereas that money we have either invested in the securities or otherwise invested in the loans. And the investment we don't want to encash, and loan we cannot expect the loan to be repaid just because your depositor wanted money. Am I right? And as such, there is a gap, and that temporary mismatches are managed by banks by way of borrowing from other banks or borrowing from the participants who are there in the money market. Hope point is clear. Point is clear. Yeah. I'm not getting any response. Good, thank you. Now, when money is borrowed for overnight, means only not more than 24 hours, 1 day borrowing, that is known as call money. More than a day, up to 14 days is called as a notice money. And more than 14 days, up to 1 year is known as term money. So money market being the short-term market operates only with the short-term instruments, call money, notice money, term money. And they below 91 days also, there are treasury bills. Okay. Now, these instruments which are traded in the money market, we'll discuss separately. That time I'll talk on that. Okay. Now, who is a regulator for money market? RBI is a regulator. What is that? Financial Market Regulation Department is there in the RBI. It works as a regulator. Who can participate in the market? All scheduled commercial banks. RRB, Small Finance Bank, Payment Bank. Who is not allowed to participate? Who is not allowed to participate? Local area banks are not allowed. Cooperative banks, scheduled cooperative banks, district cooperative banks and DCCB are not allowed. Okay. Then primary dealers can participate. Okay. Only primary cooperative banks can participate. Then what is the market timing? 9 to 5 daily on business day. Normally treasury bills are traded on Wednesday. And the treasury bills are different. That is treasury bills, government security, then state development loan. These are all on Tuesday. Then sovereign gold bonds, you know, that is being as and when Reserve Bank of India announces. That time only they are either purchasable or sellable. Okay, sellable only on maturity date. Okay, so this. Then as far as RBI guidelines concerned, RBI guidelines are here. You can see very clear. A bank scheduled, that is scheduled cooperative bank, RRB, small finance bank and payment bank can borrow up to 125% of their capital funds. But on any time, it cannot be on a fortnightly average more than 100% of their capital funds. Means bank's capital equal amount only can be borrowed on an average basis. But on any single day, it can go up to 125%. At the same time, how much one can lend? 50% of their capital funds can be lent. Whereas fortnightly, it should not exceed 25%. Fortnight average, 25% means 25% of the capital funds only can be lent out. So for a cooperative bank, the rule is very strict. Rule has nothing to do with their capital, but their total aggregate deposit. That aggregate deposit, 2% only can be borrowed. They are not permitted to lend in the money market. Okay. Whereas for banks, lending, no limit is set up. Okay. Then primary dealers. Sorry. Okay. So for a cooperative bank, there is no lending limit is being fixed. Okay. Then primary dealers are there. Who are the primary dealers? We'll try discussing in the next slide. They are allowed to borrow 225% of their capital funds. Okay. And they can allow 25% of their net own funds or capital funds. So these are the few terms you have to keep it in mind. Now let us see which are all the instruments which are traded in the money market. Number one is a Treasury Bill. Treasury Bill is a short-term borrowing instrument which is actually issued by Government of India, and there is no rate of interest specified. It is sold at a discount, means 98 rupees 10 paisa you invest, after 91 days you get 100 rupees. That is what is written. I promise to pay you 100 rupees at the end of 91st day, and you are being asked to pay only 98 rupee 10 paisa. In the form of 1 rupee 90 paisa, you get an interest for 91 days. And you need to now calculate if the interest rupees 1 rupee 90 paisa is for 91 days, what is the rate for per annum? So that's the way you can arrive at. But the point is not that. Point is, instrument is issued at a discount. And these instruments are, once somebody invests it, they can only now able to sell in the money market. So government issues like this, and they are getting traded in the money market. Okay. And there are 91 day, 182 day, and 364 days Treasury bills. Minimum lot 25,000. Whereas individual person is also allowed to now participate in the money market, provided they have to have an account with Reserve Bank of India, that is retail direct gilt account. And now it is being operated by CCIL, Clearing Corporation of India Limited, through negotiated dealing settlement, and where 10,000 lot is available for retail customer. So this is what about the Treasury bills. If you have any question, immediately make a note somewhere. I'll give a time. At that time, you can ask me. Okay? Not now. You can make a note of a question if at all you have with regard to Treasury bill. Now, the other instrument is certificate of deposit. Exam point of view, remember who is permitted? Scheduled. These are only permitted to be issued by bank. Okay? And payment bank and local area banks are not eligible. Means who cannot issue? The payment bank and local area bank cannot issue certificate of deposit. Again, certificate of deposit is a money market instrument. Many people get confused. Sir, every bank issues a deposit certificate. No, this is not that deposit certificate which we issue to customers. This is a money market instrument. Okay. Yeah, below 91 days, there is a cash management bill. We will discuss separately. It is nothing but for less than 91 days, an instrument which is being floated by the government is a cash management bill. Okay. Then next is a certificate of deposit. Who can issue? Bank. Which bank? Scheduled corporate commercial banks, RRBs, and small finance bank. Who cannot? Payment bank and local area banks. They are not allowed. Then period 7 days minimum, maximum 1 year. And for select financial institutions, it may be 1 to 3 years. Okay, minimum 1 year and maximum 3 years. Amount 5 lakhs and in multiples of 5 lakhs. No loan against CD. Bank will not sanction any loan against CD. And however, banks have an authority to buy back only after 7 days. Money market instrument, another instrument is CP. CP and CD, the difference is CD issued by bank, CP issued by companies and NBFCs, all India finance institutions. Here condition is For a cooperative society, trust and LLP, a condition is that there must be a minimum net worth of 100 crore. Whereas for NBFC, company and other financial institutions, no such condition. Minimum 5 lakhs and in multiples of 5 lakhs, 7 days to 1 year. Here there are 2-3 important stipulations are there. Number one, they must have to have a credit rating A3, which is specified by SEBI. And for issue of 1,000 crore and above CP lot, then they require 2 ratings. CPs can be bought back by the company who issues the CP only after 30 days, that is not before 30 days of maturity. Okay, so that allowed only not before 30 days. As I told you, cash management bill is an instrument for less than 91 days. And the participants who are not permitted to participate in the, are those who do not have a account with Reserve Bank of India, not having access to call money market. For them, there is an instrument called as CBLO, collateralized borrowing and lending obligation. Here, it is simply a system wherein someone can invest or someone can borrow in the form of by handing over security, I can borrow, or by giving money, I can buy. A minimum rupees 50 lakhs and in multiples of thereafter 5 lakhs. It also instrument is for 1 day to 90 days. Someone can buy, someone can sell. The rate of interest for that is decided by FIMDA. Exam point of view important. That is Fixed Income Money Market and Derivative Association of India. Okay, then repo. I think all of you know repo is nothing but selling of security by banks with the agreement to repurchase after a definite period of time at a predetermined price. This repo is also known as ready forward. Repo is nothing but repurchase option. Repo means a ready forward transaction. Okay. Similarly, banks can further buy, further borrow by giving the securities, which are part of the securities reserved for your SLR purpose. And you can make use of, means bank can make use of 2% of the NDTL for the purpose of additional borrowing. And for that purpose, there is a additional rate of interest charged on the MSF. That is, MSF rate is always higher than the repo rate. Reverse repo is nothing but banks deposit money and buy the securities with a promise to sell it back. It is nothing but repo is selling the securities, getting money with a promise to give back the money and get back the security. Whereas reverse repo is giving money, buying securities with a promise to sell the securities after a particular period of time. And repo and reverse repo are the instruments used by Reserve Bank of India also for leveraging on making easy money or tight money, or banks are also using it for the purpose of their requirement. So this is what repo, reverse repo and MSF. Then who are primary dealers? Primary dealers are the people who are registered with Reserve Bank of India to participate in money market. Participate in money market, that is either a primary market or in the secondary market. Who are all they? I think exam point of view not important, therefore better not to involve in that. But remember few things, that there are banks also can be a primary dealer through their department. They have to take a specific permission from Reserve Bank of India, and these are the selected banks which are part in that. I will share with you the presentation copy. You can read it leisurely. Exam point of view not so critical, therefore I wish I should move further. Okay, then as far as fixed money market, fixed income market concerned, there are the debt markets, and in the debt market there are GSECs other than the Treasury bill, government securities other than the Treasury bills. These securities are known as the gilt-edged security. Why they are known as gilt-edged security? Because there is a promise by the government for that. Therefore, they are known as gilt-edged securities. Okay, and the gilt-edged securities are also again issued at par, rupees 100, not at discount. whereas there is a rate of interest specified. That is, rate of interest is decided through auction. Rate of interest is decided through auction, bid and ask rate. Okay, tenor is 1 to 30 years. So dated securities, dated G-Secs, 5 years to 30 years. Central government can issue G-Secs, both Treasury Bills and G-Sec, whereas state government only can issue the State Development Loans, SDLs. State government can also issue the bonds. Bonds can be also issued by the corporate. Okay, and this period as per requirement. Rate of interest may be fixed, may be variable, depending upon the market, how it works. So this is what is a G-Sec, bond, state development loans. Now fourth is the sovereign gold bond. Exam point of view, there are two important points to be noted. Number one, the minimum 1 gram and maximum 4 kgs per annum for individual and HUF, whereas 20 kgs for trust, society, etc. Okay, means for an association, trust, society, it is 20 kg. For an individual or HUF, it is maximum 4 kgs per annum, 20 kgs per annum, and this minimum 1 gram. And per annum, when we say, so it means that whenever Reserve Bank of India opens the tranche, we can go on buying 1 kg, 1 kg, 1 kg. Last, even if we want to buy 2 kg, we will not be allowed because maximum 1 kg. Okay. Normally, sovereign gold bonds are repayable at the expiry of 8 years. And for the period for which the gold bonds are issued, rate of interest is provided at the rate of 2.5%. When you want to buy as well as sell, it is at the market price. Previous 3 days average price is considered as a basis for determining the rate. So exam point of view, only 3 important points. Number 1, minimum, maximum for individual and the trust. Then number 2, repayability. Number 3, rate of interest. That's all. Here is another very interesting area, interest rate swaps. Interest rate swap need to be understood like this, that it is simply a contract without exchange of money. There is no money exchange, but it is a notional amount. For example, there is me, Pradeep Kulkarni, okay, and there is another participant called Kavya. Kavya is there here. Now, Kavya and myself, Pradeep Kulkarni and Kavya, enter into an agreement, okay, as if that I am borrowing 1 crore from Kavya and she is borrowing 1 crore from me. As such, there is no exchange of money. But the rate of interest, what we have decided today is, today, I have told that as on today, there is a 4.50 is a repo, assume, okay. And what I am telling, 4.50 plus 2% is the rate at which you have to give me money, interest. Okay, so this is a floating rate I promise to give her. Whereas what Kavya says, 6.5% you need to pay. Means, to be very frank, there is no gain, no loss. When there will be gain, when there will be loss, in case over a period of time, the repo is reduced. Repo got reduced to 4%. What happens? My rate of interest, means money which I have lent, on that rate of interest will be 4 plus 2, 6%, whereas I need to continue to pay at the 6.5%. Hope this point got understood. So it is simply to make ourselves risk-free from the interest fluctuation. This is a created instrument, okay, based on the underlying agreement. There is an instrument created, that is an interest rate swap. Okay, so this simple way it works. Then for the purpose of this, the floating rates for our for the purpose of fixing an interest rate, that is the external benchmark lending rate, as well as for the swaps, as well as for the money market instruments, FBIL, that is a Financial Benchmarks India Limited, which fixes the rate. Okay, MIBOR, MIFR. Okay, then FIMDA, as we have already discussed, Fixed Income Money Market and Derivative Association, which decides the rate of interest for the bonds. Then FEDI, Foreign Exchange Dealers Association of India, prescribes rules relating to managing foreign exchange transactions. Indian Banks Association gives rules and norms relating to various nitty-gritties of bank functioning. Then let us continue now. Reserve Bank of India, okay, constituted under section RBI Act, okay, and there is a central board, then monetary policy committee. Central board consists of 21 members, okay, central board consists of 21 members, and first of all, out of the 24 members, there is a governor, RBI appointed by the government of India. Then there are 4 deputy governors. There are 4 additional directors who are from each one of the local boards of RBI, Mumbai, Delhi, Kolkata, Chennai. 10 directors are nominated by government. In all, you have to remember only one thing, that is 21 members are in the board. RBI governor is the head. 4 are the deputy governors. And 4 are the local boards. 10 directors by government of India. Leave it. Then next is this repo and reverse repo. Who decides? It is decided by Monetary Policy Committee. Monetary Policy Committee is this committee which takes the decision with regard to repo and repo. Policy rates are determined by Monetary Policy Committee. Monetary Policy Committee is constituted as per section 45ZB of RBI. Committee consists of 6 members, headed by RBI governor. 3 members totally from RBI, 3 members are from Government of India. Okay, that mandate is at least once in a 3 months they must have to conduct a meeting, whereas in our country now they are meeting bi-monthly. But as per mandate, they need to meet at least once in a quarter, that is in a year 4 times, at least 4 times in a year. They have got a target, that is inflation management, and that target they can maximum plus or minus 2%. Okay, present year target they are fixed what, 4%. I think these are all things I need not have to discuss. RBI is a monetary authority. RBI is an issuer of currency. RBI is a bankers to banks, regulator of banking system, managing foreign exchange, and as well as IRAC norms. So all these aspects we otherwise also going to discuss in detail one by one. However, these are the latest things. You may take a note of it. I'm moving further because not this is all. Wholesale banking and retail banking. Retail banking is a banking which is provided by us to an individual customer, which has got a multiple products. That is, saving products are there, loan products are there, service products are there. So multiple channels of distributions are there. The service to individual is provided through a branch, through ATM, through net banking, through mobile banking, through SMS banking, so through phone banking. Multiple way the banking is being provided. Multiple customer groups are there. So there are retail customers in the form of employees are there, farmers are there. Okay, so likewise the multiple groups are there. Retail deposit product, loan products, and retail service. Whereas for a wholesale banking is nothing but providing banking services to industrial and business enterprises. When we provide banking to a business activity or manufacturing activity, then it is known as wholesale banking. Mostly it includes the corporates. Okay, whereas small industrial person, individual person, it also included under the retail only. Okay, fund-based services we provide, non-fund based service provide. Then also we provide the working capital finance, term loan, demand loan. We give the guarantees. Guarantees are performance guarantee, financial guarantee, deferred payment guarantee, multiple guarantees we issue. We also undertake the forward agreement contracts on behalf of customer. We also book foreign exchange contracts for the corporate customer. And when all sort of services are offered under one shell, under one shelter, then we call it as a universal banking. Okay, RBI governor's term. RBI governor's term normally for a period of 3 years. Okay, Forex and international banking. export, import, cross-border remittances, letter of credit service, supplier's credit, buyer's credit, guarantees, all these are a part of wholesale and retail banking. And this is only an overview. No need to worry. All these aspects we'll be covering one by one in detail. Okay, capital market as such, who is a regulator? SEBI. And actually, SEBI regulates the stock exchange. SEBI regulates the broker. SEBI regulates the investment bankers, merchant bankers, FIIs, mutual funds, custodians, depositories, and the listed companies. It actually supervises and controls the equity market and debt market. Equity market is shares, debt market is debentures, bonds. Debentures, bonds are the under debt market. FII is a foreign company registered with SEBI for investing in Indian stock exchange. Okay, foreign, that includes a foreign investment bank or foreign mutual fund which is interested in investing in Indian investment market, that is a capital market. Then those are known as FII. Who is a broker? Broker is a middleman who has authority to buy and sell the shares and debentures in a stock exchange. He does so on behalf of the investor. He is known as broker. Is it clear? For a bank, there are few things to be noted that for a capital market, maximum bank can take exposure, 40% of our net worth. There is a word called as Masala Bond. Masala Bond is nothing but the bond issued by our Indian corporate in Indian currency, issued to the foreign residents. Okay, because they don't want to carry the risk money. Yes, sir. Is FII need to register with SEBI? Definitely, FII need to register with SEBI. Without registration, it will be very difficult. Otherwise, we will be a part of the money laundering. Okay. In spite of duly registered FIIs, still people are indulging into money laundering activity. Okay. Then what is depository? Depository services, very important for exam. So one by one, I am going very slowly, try understanding. Okay. As far as in India concerned, there are only the two depositories. Okay. Who are all? Two depositories are NSDL and CDSL. Okay. NSDL and CDSL. Actually, whenever a company issues any shares, that time company is depositing those shares with the depository, and that depository is telling us that Mr. Kulkarni, you got allotted 500 shares from this number to this number, electronic entry they are passing in my demat account. Okay, that's what is the role of a depository. Okay, so repository is basically a custodian who takes into custody the shares and gives the investor that you are allotted by this company these shares. Okay, and we are dealing in a electronically and recorded numbers. Okay, actually shares are with whom? Shares are with depository. So in the process, there are some critical issues comes. What is ADR, GDR, IDR, EDR? So ADR is nothing but an American depository receipt. What is that? For example, our ICICI Bank, they want to raise money in the foreign market. At the same time, they want that ICICI Bank must be traded in the New York Stock Exchange. If they want to get traded in the New York Stock Exchange, they require a bond or something which can be traded in the New York. For that purpose, what ICICI Bank does, it gives some shares to a depository in New York, and that depository in New York says, okay, so ICICI Bank 10 shares is equal to one depository receipt which can be traded at XYZ number dollars in the New York Stock Exchange. And from then onwards, it will be going on floating in the market as a instrument. Okay, so that is what is an American depository receipt, because it is an Indian company wants to trade in American Stock Exchange. Clear? Now, Amazon may be wanting to get traded in Indian stock exchange, that is a national stock exchange. Then what happens? Then they have to give their shares to either NSDL or CDSL, and they will get a lot, and then that get traded in our stock exchange, and that is in India, that is rupees. Okay, foreign company, Google, Amazon, Walmart, they want to get listed, that is IDR. Whereas any other company which want to list not only in New York, but also in London Stock Exchange or Hong Kong Stock Exchange or Singapore Stock Exchange, then they have to compulsorily go for GDR, Global Depository Receipt, because in ADR only traded in New York, whereas GDR can get traded in New York as well as the other stock exchanges. EDR is similarly for European countries. Clear? Very important for exam. Compulsory question comes. If you have any doubt, you can ask me at a later stage also, no problem. Okay, the next is a participatory note. See, participatory notes are the notes issued by FIIs to the entities. Actually, these entities are not registered with RBI. FII is registered with RBI, but these entities who are being giving money to FII, they are not registered with our SEBI. Okay, so the entities money is there with FII. FII is investing in our market. Okay, and that notes which are issued by FII to the entities which want to invest in Indian Stock Exchange is a participatory note. There are rules, regulations are there, but don't worry, for your purpose, this much is more than sufficient exam point of view that I'm talking. Okay, next is the multi-commodity exchange. What is this multi-commodity exchange? This is an exchange where, like shares, the commodities are traded. Which commodities? Commodities such as bullion, commodities such as metal, commodities such as energy, commodities such as agriculture products are getting traded. And these are getting traded means to derive the price of that commodity in advance. For example, I may buy cotton in the month of now coming December. Today is a June. Cotton is not yet sold, but I know that there will be demand for the cotton. So I am buying 10 lakh tons of cotton in the month of December at a particular rate. Okay, I am ready to buy, provided someone is ready to sell. That is how that trading happens. And that trading is happened on multi-commodity exchange of India. Okay, and not only the gold, silver, but aluminum, copper, lead, zinc, nickel, energy, and agriculture produce all are traded in the form of either futures or options. Option is a derivative where I am entering into an agreement of buying, but I have an option to buy or not to buy. For example, at the end of a particular period, price is not favorable. I will say I won't buy. That kind of option, when it is provided in the derivative, then that is called as option. Whereas futures are nothing but the forward agreements, okay, forward rate agreements, which are settled on a particular settlement day, and the are either we get earnings or otherwise we get lost depending upon the rate at which it gets traded at a particular frequency. So this is the difference between future and options. Share, very interesting. There were many questions on this in the group. I have seen in the groups various people were asking, sir, what is the difference between cumulative, convertible, preference shares? Simply remember, share is a part of the capital of a company. If company is issuing, company is in need of 1,000 crores for the purpose of their business. Now they are floating shares for 1,000 crores, and there are many people, maybe 1 lakh people might have purchased the 1,000 crores worth shares. For a simple practical purposes, let us assume each person has purchased 1 crore, 1 crore invested, and there are 1,000 people have invested in this company. Now, after 3 months, I am not interested in the company. I want to sell. If the company is really doing good, there are many people who may be waiting for that particular company shares because company has issued only 1,000 crore, not more than that. So people are more in demanding. So naturally, my 1 crore rupees, I may fetch 1 crore 5,000, 1 crore 20,000, 1 crore 1 lakh, 1 crore 5 lakhs, depending upon company. That's the way this company share gets traded on the stock exchange. But a share cap holder, being the owner of the company, he is known as equity shareholder. He is the last person to get money in case company gets liquidated. Number two, even if the company makes profit, he do not have any claim to be made on the company's profit unless and until company declares the dividend. Whereas preference share is a preferred for the purpose of paying the dividend at an agreed rate. Not only that agreed rate, but also they are getting a preference while company under liquidation. Means before equity shareholders, they will get their money. Thereafter only equity shareholder. There are cumulative and non-cumulative preference shares. Cumulative preference share means whatever dividend that is being they are entitled for, even though the company is making losses, that gets accumulated. That is cumulative. Whereas non-cumulative is the dividend as and when it is paid. That's what is a non-cumulative preference share. And these, whatever preference shares, they have a entitlement of getting converted into equity. Then it is a convertible preference share. The preference shareholder do not have a right to participate in the profits of the company. Whereas if a share is issued as a participating preference share, then that person will also, in addition to the regular dividend, he may be getting the part of the profits of the company in case like the all other equity shareholders. So redeemable, non-redeemable, perpetual, multiple way the terms are used. Redeemable means repayable back. Non-redeemable means not at all repayment. You have to only trade in the stock market. Perpetual is it continues to be like a equity only. So that's what are the different terminologies used with regard to share. Debenture is nothing but a loan raised by the company. So earlier 1,000 crore and company wants 2,000 crore, but they are issuing only the 1,000 crore shares, and 1,000 crore they are issuing debentures. That is a loan from the public. So debentures, bonds are nothing but the loan instruments. These are all the creditors to the companies. And these debentures always have got a definite rate of interest. Interest is normally paid half yearly. Whereas bonds, they depending upon the feature of the bond, there may be a coupon bond, there may be zero coupon bond, there may be convertible bond. Same way, debenture also may be redeemable or non-redeemable, that is a convertible. Okay, possible. So coupon bonds are the particular rate of interest is stated there, and that rate of interest they will get at a on a yield on a maturity basis. Fixed predetermined rate of interest is known as coupon. Zero coupon is no interest is stated on that, as if that, for example, instead of giving me the 1,000 rupees, I simply need to pay 910 rupees. At the end of 3 years, I will get the 900. At the end of 2 years, I will get 1,000 rupees. So, in simple words, 100 rupees is a interest for my 900 rupees investment. Such a way, if it is prescribed, it is known as zero coupon bond. So it is issued at a discount. No periodic interests are paid. At the end only, I'll get the maturity amount. And anything, either a bond or the debenture, if it is convertible, means this can get converted into equity shares. So here are few terms which are very important. Security transaction tax. Security transaction tax is a tax levied on the people who are trading in the stock market, either sale or buying. Both they need to pay up to 0.1%. Different rate of interests are there. Okay, that different tax rates are there, but generally 0.1%. Then there is another term, pay in and payout day. Pay in day is nothing but a day on which broker need to make payment in case he is purchasing shares, or in case he is selling the shares, he need to deliver the securities to stock exchange. So that is what is a day known as pay in day. Pay in day is broker need to make payment or deliver security. This is what is a pay in day. Payout day is nothing but day on which exchange gives the payment to broker or exchange delivers the security to the broker. Payout day. So pay in day, payout day. Normally this happens T plus 2 days, means today I enter into transaction. Normally third day will be either pay in day and payout day normally. Okay. There is a word called as IPO. IPO is nothing but now LIC came up with the shares. First time they have issued shares to public. So therefore it is IPO. If after 5 years again LIC is coming up with the shares, then it is known as follow-up public offer or further public offer, follow-on public offer, that is FPO. So Forex market is a very interesting market. Very interesting market. The reason why it is interesting, because it's a over the phone market. It is an interbank market, and it took a shape over a period of 50 years. Okay. Earlier it was a fixed rating system. Now it is a floating rate. Means exchange rates are determined on a floating basis depending upon the demand for a particular currency in the international market. Okay. It is a 24-hour market for luckily India, because India has got an advantage that when we close, London gets open. And when London closes, Singapore gets open. Like that, 24 hours, this market is available. So throughout 24 hours liquidity, and very promptly the transaction gets settled. Huge amount gets traded. Okay. These are all the few features of Forex market. You keep remembering exam purpose. Okay. Now, the no more LIBOR domination. Earlier, LIBOR was very much dominating. Now, to overcome the LIBOR domination, that is a London's domination on the Forex market, the all over world, the Forex traders, they have decided that why they should not switch to alternative reference rate suiting to that particular company's, that country's currency. For example, US, it is a soft. EU, it is ESTR. Switzerland, it is Saron. UK, it is Sonia. Japan, it is Tonar. Like that, these 5 alternate reference rates are being devised and they are under operation now. Who is a qualified institutional buyer? Qualified institutional buyers are the authorities who are there, entities which have expertise in investing in the market, such as the public financial institution, mutual fund, pension fund, who are bound to enter into money market or capital market. So those are known as the qualified institutional buyers, and these need not have to be registered on SEBI. No need to be registered with SEBI. Merchant bankers are the banking companies or non-banking finance company who actually undertake the role of underwriting the new shares, syndication of loan in case the company requires. Those who have surplus money and those who need money, they start playing as an intermediary role. Okay. And they obtain the regulatory clearances. They underwrite the IPO. They plan for their IPO, appoints the registrar, broker, sub-broker for the issue. So they manage the publicity. All this job is done for company or corporate. They are known as merchant bankers. Who are the portfolio managers? Portfolio managers are the people or the bankers or non-banking finance company, those who have expertise in managing someone else's portfolio so as to provide him agreed profit, agreed returns. So efficient management of combination of securities, reducing the risk to the ensuing other person is a portfolio manager's role. Okay, so now let us come back to the insurance now. IRDAI is a regulatory insurance and regulatory authority, Insurance Regulatory and Development Authority of India. And this authority is a key regulator for insurance business in our country. And they have prescribed the minimum required, the capital requirement for an insurance company at 100 crore. Whereas they have also suggested that in case some insurance company coming up with micro insurance exclusively, for them only 20 crores. Okay. So what is the job they do? They make a framework for insurance company, which includes general life insurance company. They are even regulating the price and cost structure for insurance products. They also regulate the insurance agents, brokers, and their qualifying exams, etc. are being managed by IRDAI. What is the insurance? Is a contract of indemnity between two parties. In case there is a loss happens to one person, the company is agreed to make the good of the loss in terms of money. One promises to indemnify the other to make good the financial loss suffered by the latter by the conduct of either the insurance company or by the conduct of any other person. So that's what, and for that purpose, person need to pay premium, and the contract is policy. Contract is policy. Since the loss cannot be decided in advance, this kind of contract is known as, it is a contract of contingent liability. Liability may occur, may not occur. So insurance business, who are all the players? There are public sector players are there. Public sector players, LIC is a great public sector. And then in addition to that, there are 23. General insurance, there are 4 plus 29. And agriculture insurance company is also there. Agriculture insurance company, life insurance company, all these are the public sector companies. Whereas these 29, 23 are other private insurance companies. Okay. And there is one reinsurance company, General Insurance Corporation of India. To understand the reinsurance like this, someone want to insure their 400 crore worth ship. Ship is there. Am I right? Everyone knows that ship may cost 400 crore. And that 400 crore worth ship need to be insured. Now, none of these companies have got that capacity to bear such a huge risk. What do? They go to General Insurance Corporation and ask the bid. So then General Insurance Corporation gives this much premium, you can take a policy from me. Over and above that particular premium which is quoted by General Insurance, these insurance company will add their own margin and tell it to the client. That is what is a job done by the insurance companies. And over the world, it happens like this only. Is it clear? Is it clear? Can I get some symbol? Somehow I'm going a one way, but I don't know. Hope I'm clear. But anyway, okay. Now, as far as good. Thank you. So insurance is as usual. I have already said this. Now, how many type of policies are there? So you can see the life insurance policies: term life, whole life, endowment, money back, annuity. Okay. Generally, people get confused between term life and endowment. Okay. Here, term life policies are for a fixed term. No maturity value will be provided. Upon insurer's death, the particular amount is promised. Okay. That means it is relating to amount of insurance only. Whereas endowment policies, there is a fixed term and a maturity value also is provided there. This is the difference between term life and the endowment. Whole life is no fixed term till such the person lives 99 years, like that it is considered as a whole life insurance. Money back plans are there. After a definite period of 5 years, 10 years, some money will be repaid, returned back to the insurer. That is what is a money back plan. And people like me who are the retirees, they prefer the annuity plans, and I invest money with LIC, and they offer me the insurance also. They also give me a definite amount returned to me, agreed return. And that's what is a deferred annuity. I continue to get immediate annuity or deferred annuity. Immediate annuity means I invest and immediately the return starts. In some cases, for example, Jeevan Suraksha offered by LIC, wherein compulsorily I need to wait for 1 year. Okay, so like that, there are different plans are offered by insurance company. Can you post PPT? Yeah. What I'll do now, tomorrow I prefer you, but tonight again I need to look into for tomorrow morning session. Okay, that today evening session. So give me some time. Tomorrow, both the things, both put together, I'll post it. Okay, thank you. Nice. Okay. Then unit link insurance, I think all of you are aware that whatever money we pay to insurance company, a part will be invested and a little part is considered as insurance. And whatever the value that money gets earned by way of their units, that will be returned back to me. So this is what is the unit link insurance policy. Means it works as a investment plan, also the insurance plan. So these are the life insurance. Health insurance is there, which includes the room, boarding, nurse charges, doctor fees, pathology, etc. That is a health insurance, and all of us are compulsory to take a health insurance from a particular insurance company, which nowadays become a mandatory. After COVID, even general public is aware about that. Many people are buying the insurance. Now, motor insurance also a compulsory thing, therefore we all buy. In that, there is a liability, only a third party is there, and package is also there. Okay, and these are the motor insurance policy. There are the shopkeepers policy, fire policy, or accident policy, or home policy is there, where fire and other accidents which are covered, that is a fire and other insurance policies. Okay, so these are the multiple policies are there, which are, these all are known as a general insurance. These are covered under general insurance, and earlier whatever I have told are the life insurance. There are, whether it is general or whether it is life, these are the few important words with regard to LIC policy, which comes number one, insurable interest. I cannot insure, for example, I cannot insure the Kavya Ramana's life. For example, I approach an insurance company and I say, I want to have a policy in the name of Kavya Ramana for 5 crore or for 5 lakhs, for 10 lakhs. No doubt I am ready to pay premium. It is not allowed because I do not have any insurable interest in Kavya. Whereas I can insure my grandson's life. I can insure my son's life. I can insure my wife's life. That's the insurable interest I do have. So similarly, as a banker, we have insurable interest in our borrowers' properties. Therefore, we have a right to insure the borrower's property, that is either a stock or the building. So that is an insurable interest. Good faith is means whatever we state in the policy assumed to be a truth one. And indemnity is offered by both, means in case we provide some wrong information and as a result company provides policy and makes the payment, in case company founds it afterwards, then we are supposed to make it good. Okay, this is what is an indemnity. Subrogation is a, for example, our motor car and we hit somebody. When we hit somebody due to mistake of a vehicle coming from behind me, I hit someone and third party insurance I need to incur. What happens? Insurance company pays back to the to that particular person because I have taken the insurance, but they also make a suit against that person who hit my car. They have every right to file a suit against that. That is a right of subrogation. Okay, so these are all the things which are very, very important principles of insurance. And exam point of view, another important aspect is insurance. Okay, Jyoti. So who can insure your life, Jyoti? You tell me. Who has got insurable interest in you? Means your life is really important to them and they have some stake in your life. Okay, as a student, you are my student, you are a very good student, but I do not have any insurable interest in you. Even if I approach insurance company, I pay the premium. What is the problem to you? Insurance company will not accept my money and they will not offer any insurance policy in your name. Is it clear? Is it clear? Good, thank you. No, I am asking Jyoti. Jyoti asked me question. Okay. Anyway, there is an insurance ombudsman, like our banking ombudsman, there is an ombudsman, and I have seen many queries coming up in Telegram as well as the our various groups. Sir, whether it is 30 lakhs or whether it is 20 lakhs, please make a note. The insured amount has nothing to do, to be very frank. It has something to do with the claim. The claim amount should not exceed rupees 30 lakhs. Claim amount, including the expenses, should not exceed rupees 30 lakhs. Such a complaint only are entertained by the insurance ombudsman. Insurance ombudsman is an authority appointed by Government of India under IRDA Act, and as usual, their term is 3 years, appointed for a period of 3 years. And for anything which has happened to me within 1 year, I need to make a complaint to the insurance company. Insurance company has got a time of 30 days to reply to me. In case I don't receive any reply from the insurance company, or I receive a reply but that is not satisfactory to me, I can approach the insurance ombudsman, and insurance ombudsman can try, first of all, reconciliation, try that accommodative way of dealing the things. But if there is no settlement coming forward, the ombudsman gives award, and such award not more than rupees 30 lakhs. Okay. At present, there are 17 insurance ombudsmans. Okay. Mutual funds, I don't think we need to talk, but if at all you have any question, you may ask me very quickly. Otherwise, I am not that interested in talking on mutual fund because I have a lot of things to discuss with you, and therefore I want to just move further. Can I move? Can I get some symbol? So with regard to mutual fund, remember only one question you can expect, that is AMCs. AMCs are in the form of trust. They are formed as a trust. Okay, the trustees hold the property on behalf of unit holders. And the second question expected is net asset value, NAV. NAV, how it is calculated? The total investment made by that particular fund, value of that fund, that those shares, debentures in the market, minus expenses on a particular date. Okay, that is the amount which is available divided by total number of units. That is what is a NAV. And this NAV becomes basis for investment in open-ended funds. Okay. Open-ended funds are the funds which are next slide is that only. Okay. Open-ended funds are the funds which are always open for investment, at the same time open for sale. Means they are liquid. They are liquid funds. And while investing, I need to invest in that on the basis of NAV, net asset value, on the basis of NAV. Whereas close-ended funds, I do not have the opportunity to invest in that fund. Only I have an option to get either units from somebody, buy it in the secondary market, those units. That is the only option I have got with regard to close-ended funds. Okay. So this is open-ended and close-ended funds. As far as there is another important word comes as a fund of funds. What is fund of funds? Fund of funds is a mutual fund which invests in other mutual funds, maybe of the same company, or otherwise maybe other companies' mutual funds. It may invest. That is what is a fund of funds. Bank funds are there, sector specific, pharma funds are there, software funds are there. Then okay. Then depending upon the risk, equity based growth plan, the bonds, debentures, and the government securities income plan. Mix of this is a balance plan. Only money market mutual fund. Okay. So like that, the different type of funds are there. I don't think here is a point called as a finance against the bills. Ombudsman limit is 30 lakhs. Okay, do one thing, Jalaraja, you can even go to IRDAI site. Okay, Insurance Regulatory and Develop, irdai.org.gov.in. Okay, irdai.gov.in. You can go there. You will have the customer complaints. Under customer complaint, there is a ombudsman. You click that link, you will get the information. Okay. All of you make a note of it. Don't worry, because we should not get confused. Today is the world of information. Okay. So no need to worry. The next, because I have seen lot many queries, and therefore I also search for, because earlier it was 20 lakhs, it increased to now 30 lakhs. Okay. Last year onwards, I think. Okay. Now, commercial bills are purchased or discounted by the banks or other agencies. And that is what is a commercial bill business, which is under operation. Actually, over a period of time when the money is being either sent very quickly, the bill business has come down a lot. Therefore, people do not know about it. But there is always a seller sells the goods on a term basis. That is a 3 months. After 3 months, the buyer is agreeing to make the payment. Now, seller draws a bill on buyer, buyer accepts it. And that accepted bill, I can take it to bank and tell, sir, you can see I have supplied to Reliance Industries, and Reliance Industries promised to me to make the payment after 3 months. So naturally, banker has got confidence in Reliance Industries. So what they will do, okay, Mr. Kulkarni, we will make payment, but we are going to charge you that something. And that's the way they will make me payment. Since this bill is payable after 3 months, it is a usance bill. There is always possibility that you just present the bill and take the payment. That is a side bill. Side bill and usance bill. And side bill are normally purchased. Usance bill are normally discounted. Clear? Since this bill business is a wonderful tool to make money, many people started using this as a tool to raise money from the bank. A draws a bill on B. A draws bill on B. B draws bill on A. A goes to the bank and raises money against this bill. B goes to the bank and raises money on this bill. On a due date, B makes the payment and here A makes the payment. Okay, here B makes the payment and A makes the payment. Actually, there is no trade, no business, nothing. So such bills are known as accommodation bills. Such bills are known as accommodation bills. Whereas genuinely trade has happened and based on the trade, the bill is being raised, then it is a trade bill. So side bill one more time, please. Okay. For example, I have sold goods to you. What is your good name, dear? I did not understood. Okay. Kavya. Kavya, I sold goods to you. Okay. What you said? Kulkarni sir, I want 10,000 worth goods from you. Please send me the goods. Okay. I am ready to buy. You are in Hyderabad. I am in Vijayawada. What I do? I load the goods in the transport company. I have got a documents with me. And now what I'm doing, I'm raising a bill on you. Okay, I'm raising a bill on you. Now that bill, once it is presented to you, naturally you need to make the payment because there is no term is agreed. No sooner it is presented to you, you are supposed to make me the payment. Such a bills are side bills. Okay, such bills are side bills. Clear? Now, whatever it may be, even for that bill, few days are required in the bank to make a note, and then thereafter only it will come to you. Then there is a minimum 3 days are there for presentation. So in the process, I am 10-15 days, otherwise also I am losing. So I want money from the bank. Bank is believing you as well as me. What bank can do? Bank can purchase that because side bills are normally purchased and usance bills are normally discounted. Okay, this aspect is being elaborately discussed by someone who has dealt the bill of exchange in the accounts sessions. Okay, there are few regulatory restrictions are there. No loan against bank's own shares. Union Bank of India cannot finance against Union Bank of India shares. Okay, Union Bank of India, or for that matter, no bank can finance against certificate of deposit. No loan is available against Indian depository receipt. Okay. No loan against sanction against FD issued by other bank. No additional loan facility to a bank, to a person whose name is listed in the willful defaulter. Any point of time, bank cannot give a loan and ask company to pledge. It's 30%, more than 30% of paid up capital of the company shares as a pledge. Okay, means against the shares of that company, also more than 30% I cannot hold, or that 30% paid up capital of the company or 30% of the bank capital and reserves, whichever is less is a restriction. 19(2) of Banking Regulation Act. Management, MD, manager or bank is interested, such a company, bank cannot give loan. Okay. At any point of time, as I told you, capital market exposure of the bank in the form of shares, CD, bond, 40% of bank's net own funds. In addition to this, there are exposure norms are prescribed so that credit risk can be avoided. What is that exposure norms? Let us discuss when we discuss the loans part. No loan to buy the gold, no loan to buy a open plot only for sale purpose, no loan available to buy the shares for trading purpose. Clear? These are all regulatory restrictions. You have to remember, compulsory, one question will come out of them. Factoring. Factoring is nothing but just now what I have told you. So here, that is a bill business in the very structured form. That is known as factoring. Here is a trader who is supplying goods and drawing bill of exchange on A, B, C, D, E. And no sooner A, B, C, D, E people, they are accepting the bills. These bills I am offering it to factor. These bills, when factor is a person who is purchasing these debts and giving money to the trader. Okay, who is giving money. Sometimes the not entire money is given, 50% is given, 75% is given, 25% is given, depending upon the agreement between trader and factor, the amount is being returned to trader. Then the factor will wait for 2-3 months, that whatever due dates, they will present the bill, then the money gets paid by A, B, C, D, E, F. In case money is not paid by the A, B, C, D, E, F or any one of them, he will inform trader that your bill got dishonored, I am returning the bill. And now you have to make good of me. In case that facility is available, then it is a recourse factoring. If such facility is not available, nothing doing, whatever is your headache, then that is a non-recourse factoring. And as per Reserve Bank of India guidelines, non-recourse factoring is not allowed in our country. And this is being very strict, systematically being planned by the another called TREDS, TREDS, Trade Receivable Discounting System. This system is available exclusively for micro, small and medium enterprise, MSMEs only. Under the MSMEs, when they sell the goods, they supplies. Okay, once they supplies the goods and service, then the supplier locks in and uploads the invoice and receivable in the website. No sooner it locks, then buyer verifies it. Whosoever has bought, he verifies. Now, agreement means buying and selling is being known on a website. Based on this, the invoice is getting converted into a factoring unit for bidding. Then various people, banks, other financing agencies, NBFCs, they are ready to tell that how much money they are ready to give against this particular bill. That is known as bidding. Then in case the supplier himself is making some arrangement, then first of all, that is getting accepted. In case he is not coming forward, then whosoever's bid is the best bid, which is accepted by the supplier, then with that amount, the MSME will get the money. Okay, and on due date, the money will be collected. Here, the one thing is MSMEs are on one side, and on other side, the government department, public sector undertaking, those supplies only are covered there. Okay, who are corporates, government department, public sector undertaking only are covered there. Okay. So forfeiting is generally for forex trade. Forex trade, where once I surrender my bills, now that entire headache is on the person who has given me money. For that purpose, what he expects the buyer's bank must come forward and agree in addition to the buyer. In addition to the buyer's bank also to come forward to co-accept the bill. That is known as avalization. And once it is avalized, the Indian bank, that is Exim Bank, will tell, okay, you can go ahead and make the forfeit the bill. Forfeit is nothing but surrendering. Total rights on that bill are surrendered to the person to whom the bill is handed over. So as a result, customer avoids multiple risks relating to that particular transaction, the factoring and forfeiting. Okay. Generally forfeiting for a long term and the factoring is for a short term. Generally, factoring is for a domestic, whereas forfeiting is for forex trade, export receivables. In addition to this, there are off-balance sheet items, that is the off-balance sheet items, that is bank guarantees, letter of credit, forward exchange contract, and forward rate agreements. Interest rate swap I have already discussed. Okay, now bank guarantee, letter of credit, and forward exchange contract we'll try discussing now. So why they are called as off-balance sheet item? Because, for example, when a bank issues a guarantee on behalf of somebody, it is neither an asset nor a liability. Am I right or wrong? When bank is giving guarantee on behalf of its customer to somebody, whether it is a liability or asset. When a bank gives loan, whether it is asset or liability. When a bank gives loan, whether it is a loan or a liability or asset. Okay. Good. I think good. Bharti accept Bharti. Bharti, please note, anything we accept and bank accepts and bank promises to pay back is a liability. Whereas anything where bank is supposed to get back is an asset. So bank loan is an asset. When bank issues a guarantee, whether it is a liability or asset, there is neither a liability nor an asset, but it has got a potential to get converted into an asset. Am I right? So therefore, these are written under the balance sheet, below the balance sheet line. Therefore, they are known as off-balance sheet item. Off-balance sheet item. So it won't appear on the face of balance sheet in the asset side, whereas it is appeared here. And off-balance sheet is item appearing here. Okay. What is a bank guarantee? Or for that purpose, guarantee, bank is promising on behalf of its customer. Bank is promising on behalf of his customer to someone else that they are ready to make a good of any loss occurred to him or due to non-performance of that particular fellow or non-payment of that particular fellow, any sum of money to him. So this kind of promise bank is giving on behalf of his customer. So that is a bank guarantee. And bank guarantee is already discussed to you in the legal, in the banking. Multiple times it is discussed. So therefore, I don't think that there is a need to discuss the concept of bank guarantee here. Okay. Bank guarantee is this. Then let me focus on, legally speaking, section 126 of Indian Contract Act is talking about the guarantee. A contract of guarantee is nothing but a contract to perform the promise or discharge the liability of a third party. Means A is a person who is entering into agreement with government of India to construct a road, and now he is approaching the Canara Bank and telling that he is interested in taking the contract of government of India, but government of India wants I must give a bank guarantee worth 5 crore for the 5 crore worth contract. Then based on the credit rating of A, Canara Bank is giving the guarantee to government of India. Now this A has promised to do the job. In case this fellow do not perform the job or fails to perform the way in which it was expected, so government of India can claim money from Canara Bank. So this is what is a contract of guarantee. Hope point is clear? Can I get some signal that it is clear? Hello. Good, thank you. Now, who are all the parties to a bank guarantee or for a guarantee contract? There is one guarantor, there is one principal debtor or promisor, there is one creditor or beneficiary. Good, thank you. Good. Now, how many type of guarantees are there? Basically, there are 3 type of guarantees: performance guarantee, financial guarantee, deferred payment guarantee. Let us, the example which I have given you, there is no promise of Mr. A to give any money to Government of India. It is a construction of road. That performance was the basis, and for that the bank has given guarantee. So it is a performance guarantee. There may be possibility that the Mr. A is entering into a contract with Government of Telangana. For what purpose? That he wants to start a wine shop, and for every quarter this fellow need to make the payment of 50 lakhs to Government of Telangana. So for 1 year he has to make 2 crores payment. What Government of Telangana is telling, there are 2 options to you, Mr. A. You pay me 2 crores and take the license, or otherwise you can make me payment every quarter 50 lakhs. So if you are accepting the second option, you have to give him a guarantee from the bank for 2 crores. Now, such a way where there is a promise of Mr. A to make the payment of money, and for that purpose, bank is coming forward and giving guarantee on behalf of A, then it is a financial guarantee. Deferred payment guarantee is, for example, this A is wanting to purchase a road roller from a road roller manufacturer because he has undertaken a contract of this construction of road. Now, this road roller cost is 50 lakhs. How much? 50 lakhs. Now, A has got 2 options. One is he can go to bank and take a loan of 37.5 lakhs, or otherwise he can buy a roller from the manufacturer and he can continue to pay yearly 15 lakhs, 15 lakhs, 15 lakhs, 15 lakhs. Either options are available. So he thinks that this option is better because to a bank, lot many formalities and all, so better to go with this option. So he approaches the bank and tells that my supplier is ready to give me road roller, but you have to give the guarantee to him that in case if I don't pay him 50 lakhs at the end of 1 year, you are going to make the good. That way, deferred payment means delayed payment promise is a deferred payment guarantee. Hope the point is clear. Hello. Can I get some symbol? I think except Kavya, no one is, am I not clear to others? Good, thank you. Okay, now, as far as in addition to this, there are 3-4 important aspects relating to guarantee. That is, one is every bank guarantee has to compulsorily have the limitation clause. What is this limitation clause? This limitation clause is nothing but bank guarantee is limited to a specific amount. Means this guarantee is guaranteeing 50 lakhs, 100 lakhs, 2 crore, 5 lakhs, whatever that specific amount. Okay. Then provided you are making claim before a particular date and before the expiry of this guarantee. Okay. So there is a claim period also may be stated. You have to have a claim period of 3 months before the expiry of the BG. So this claim period, BG period, this amount, okay, all these things are limiting the liability on the bank, and such kind of clause invariably must be there in every bank guarantee. Therefore, normally bank don't accept anybody's bank format unless and until there is this particular clause is incorporated at the end. Notwithstanding anything contained herein above, this guarantee is limited to this much of amount, provided a claim is made within such and such months from the due date, and this guarantee expires on such and such dates. So no claim will be entertained after that. So that's the way limitation clause must be there. In case there is any point of time, either that Government of India or that supplier makes the claim on the bank, bank will not have to be thinking about, no, I'll check up with my customer, there may be some problem, nothing doing. Once there is a bank guarantee, without any delay, without any demur, means without any hesitation, bank need to make the good to the beneficiary. And as usual, as a guarantor, we enjoy the rights on all the securities or all the assets which are there available to principal creditor, and that right is known as right of subrogation. Hope the point is clear. Anybody has got any question to ask? What is the maximum amount, maximum period for which a bank guarantee can be issued? What is the maximum period for which bank guarantee can be issued?
90 days.
180 days.
90 days.
10 years.
10 years, 90 days. Please make a note. There is no such specific period, but generally bank will not give guarantee for more than 10 years. But Reserve Bank of India removed the restriction of 10 years. Okay. Now there is no restriction from Reserve Bank of India. Clear? So any period bank can, it all depends upon bank's own loan policy. Clear? Now, let us shift our focus from, it is 9:15. Wow. I think I'm still to pass on many things. Okay. Anyway, now documentary credit is nothing but a letter of credit. Okay. Letter of credit. And this letter of credit works like this. For example, an importer is there. Importer wants to buy some goods from the person who is known as exporter. They enter into a contract to buy goods from somebody. What happens? The importer agreed from exporter to buy, and exporter wants money. Am I right? But the point is that whether these goods are allowed in that country, whether importer has got capability to pay back money. See, if it happens in India, we can visit 2 or 3 times from Hyderabad to Delhi and confirm my buyer, who is buyer and who is all. But if there is someone who is interested to buy goods from New York, then it will be very difficult to come every time to look into whether business is happening or not, isn't it? That's very problem. So therefore, what importers, whatever is about this importer, exporter says, boss, I will supply the goods to you, but I want that some letter of credit, that is some kind of assurance from a bank, some kind of assurance from a good bank, that once I supply the goods to you and that related documents once I am submitting to you, then I must get my money. And I am not going to ask you, that bank which is coming in between must make me the payment. This is what is originally contracted. Then this importer rushes to his banker known as State Bank of India. He tells all this story to State Bank. State Bank is knowing this importer. So therefore they says, okay, no problem. We have issued, we can issue. On behalf of this importer, the State Bank of India is ready to issue a letter to exporter telling that you supply the goods to him, send the documents relating to that 1, 2, 3, 4, 5, 6, 7 to me by such and such date. Then we are making you the payment of that particular supplies. Okay. Now the point is, how do exporter comes to know that these documents are really issued by State Bank? Because State Bank symbol can be anywhere printed. Am I right? It is a problem. It is a very difficult issue. Therefore, what exporter says, okay, this letter must come through my bank. And my bank should tell that, yes, this letter has been issued by one of the reputed bank in India. And that's what is I require. So this exporter's bank, it is coming in between to inform the exporter that genuinely this letter has been issued by the State Bank of India, which is one of the largest bank in India. Okay. Then this bank is informing exporter that such and such letter is issued by State Bank of India. No problem. You can make the supplies goods. Now exporter is making the goods supplies and all the documents he is making ready, and those documents he is wanting to be reaching to importer. What he does, then he handovers the document and all to his banker. His banker looks into the documents and it sees that whether as per the LC all the documents are there or not, these documents are being reaching the State Bank of India. Then once State Bank of India finds everything is document wise correct, SBI and I need to make the payment. And once the SBI is making this, the documents are reached, it informs importer that your documents are with me, come and collect. Okay, then importer makes payment and importer collects the document. By the time the goods are reaching him on the port, he goes to the port, collects the goods. So that's the way exporter, importer, both the purposes get served, and intermediary, State Bank of India acts as a promising bank to exporter that on supply of goods, that relevant documents by such and such date, you hand over to me, I'll make the payment to you. That is nothing but a documentary credit. It is more or less like a guarantee. Many people get confused. Guarantee and the credit are they appear as the same. What is the difference? Difference was we have opened, that is State Bank of India is opening this letter of credit at the importer's request. At the importer's request, favoring exporter beneficiary. And whereas in case of guarantee, A was our customer who was supposed to do the job of Government of India, whereas bank SBI. Now SBI was promising there in case A fails, whereas here SBI is promising in case the exporter performs. This is the key difference between letter of credit and the bank guarantee. Hope point is clear. Is it clear?
Sir, what is negotiating bank roles?
Let's wait. Is it whatever I have told? Is it clear?
Yeah, clear, sir.
Okay, good. Okay. Now, next point is here opening bank. This exporter, once the goods are ready, he is bringing the documents and handing over to his banker. He's handing over. Now he says his banker, sir, you already says that all documents are clear. No, do one thing. Why don't you give me some money? My money is unnecessarily blocked because these documents have to go to the State Bank of India Trivandrum. Then the State Bank of India Trivandrum will give to importer. Then they will get the money and that money will reach. My 15-20 days I'll be losing. In case there is a usance period, for that further period I'll be losing. Why don't you make me some payment? Then based on the credit report of exporter, importer, and based on this letter of credit, this bank may prefer to make the payment to exporter. And in case this bank makes the payment to the exporter, then it is said to be a negotiating bank. Clear? The bank which makes payment against the document submitted to the beneficiary is a negotiating bank. Sometimes in the letter of credit, it may be stated that document must be negotiated through only Chase Bank, New York. Then there is no other option. Document must have to go through Chase Bank, New York only. Then Chase Bank, New York is a negotiating bank or nominated bank. But in case there is no bank's name is stated, documents can be negotiated by any bank, whichever is his exporter's country or whatever that exporter's comfort, then that bank is a negotiating bank. Earlier, the same bank has routed the letter of credit to exporter. At that time, it performed the role of advising bank. Advising bank is nothing but a bank which is confirming the authenticity of the letter of credit. The bank which opens the letter of credit is an opening bank. Importer is a customer or opener. Exporter is a beneficiary. These are all the parties to letter of credit.
Confirming bank, sir.
confirming bank is a bank in the exporter's country, in addition to the opening bank, undertaking the responsibility that you need not have to worry, no need to worry to even send the documents to State Bank of India in Trivandrum. I am ready to make the payment. Okay. Means as good as I am like a State Bank to you. Don't worry. That additionally, which bank which is coming forward and entering into the transactions and making the responsibility or entering the shoes of opening bank is known as confirming bank.
Sir, so negotiating bank and confirming bank has the obligation to pay money, right?
Negotiating bank do not have any obligation. Negotiating bank is the bank which scrutinizes the document. Okay. It scrutinizes and it may pay, because for them there is a promise of another bank is there. If everything is clear, they need not have to worry about whether importer will pay or not, isn't it? So therefore, they will definitely be happy to pay, because State Bank of India is one of the largest bank in a country. Correct?
Okay, sir.
So this is what. And sometimes the negotiating bank which is in abroad, which says that we have paid the money and we don't want to wait that documents to reach State Bank and State Bank will make the reimbursement. We are not that much waiting. We want some kind of arrangement in New York itself, that we must get our money in New York itself. Then State Bank of India need to make arrangement with some bank where either State Bank of India, New York, or otherwise State Bank of India has got some connection with any other bank. Then they will have agreement to reimburse the money to the Chase Bank. Okay. Then such a way it will be acting as a reimbursing bank. So buyer, opening bank, seller, advising bank, confirming bank, reimbursing bank are the parties. There are multiple type of credits. So a letter of credit which is amendable, changeable, modifiable. See, please understand, this is a business and letter of credit coming as a facilitation. And in business, anything can happen. For example, our supplier might have agreed that the shipment will be done for 1,000 pairs of shoes, but possibility only he can make only 900, or he might have made 1,200. Now suddenly he wants amendment in the letter of credit. So then that modification change is possible. Such a letter of credit is known as revocable. Revocable at the importer's level without intimating any other party, without consent of any party, is a revocable LC. Irrevocable is no amendment or no change is possible unless and until parties to letter of credit are also consented for. Means with the consent of everybody, a change is possible even in irrevocable. And a letter of credit which is not stated whether revocable or irrevocable, it is always treated as irrevocable. Clear? Clear? A letter of credit which has got a confirmation from the confirming bank is a confirmed letter of credit. Which do not have any confirmation is an unconfirmed letter of credit. A letter of credit which is attached with the documents having a usance period is a usance credit. Document with the site bill is a site credit. Generally, letter of credit is issued for a fixed amount. One letter of credit, one transaction, one turnover. Whereas if there is a series of transactions are there, a cash credit like or credit card like limit is sanctioned, then it is a revolving letter of credit. Revolving letter of credit gets once again available to the person once the old credit, whatever was issued, gets adjusted. So that's the way revolving credit or fixed amount credit. In international transactions, issuing financial guarantee is not at all permitted in foreign countries. So therefore, what many banks, what they do, instead of guarantee, bank guarantee, financial guarantee, they prepare to give a letter of credit for making a payment on behalf of somebody. That is known as a standby letter of credit. Many a times, you know that goods are not manufactured and produced by the exporter always. Exporter may be making purchases from somebody. Okay, this is X, Y, Z are the makers, whereas P is a exporter. This A is a importer. This A is importing goods from P and P is sourcing goods from X, Y, Z. Now, what happens now when there is an order comes to P? P says that open a transferable letter of credit to me. Now, with this letter of credit, a part is transferred to A, part is transferred to Y, part is transferred to X, part is transferred to Y, part is transferred to Z. Based on this letter of credit, these people start making the goods. The goods will come to P. P may change the invoice, change the documents, or same documents he may be shipping to A. If it is a letter of credit is transferable, no such changes are required. But definitely exporter would be wanting to change, because this exporter may not be willing to disclose from where the goods are being resourced, because once they are known to his importer, then importer will next time directly contact the manufacturer only, isn't it? So therefore, letter of credit is transferable. Is letter of credit is that. In case the letter of credit originally is not transferable, based on the letter of credit received by P, he is asking his banker to open letter of credit in favor of somebody, then it is a back-to-back letter of credit. In case P is in need of money for the purpose of manufacturing a required goods to the importer, then importer may ask his banker to open a letter of credit having a facility to raise the loan by Mr. B. Means what happens, this is importer's bank will open a letter of credit, a red clause, with a clause that the exporter's bank may finance to exporter for the purpose of making goods ready for export. Okay, for the purpose of shipping, when the goods are ready, for that purpose, packing credit can be sanctioned. So in case P makes the goods ready, then his banker will, whatever loan he has given, if the P is not submitting the bills documents by due date, then they can make the demand on the opening bank. Okay, opening bank, because at their request only, a letter of credit, on their basis of letter of credit only, they have given loan to Mr. P. Such a letter of credit is a red clause letter of credit. Means where there is a facility of financing for goods manufacturing, processing, and making ready for shipment is a red clause. Additionally, if the goods are required to be stored, because ships are not like buses, okay, they are not always readily available for loading the goods. They come once in a 2 months, once in a 3 months. Now, for that waiting period, goods may be required to be kept in a store, warehouse. In such cases, that period for which the goods are kept in a storehouse, then also money is required to be financed. Then such a letter of credit is a green clause letter of credit. A letter of credit which is allowed to be negotiated with any bank is an open letter of credit, or must be negotiated with a XYZ bank is a restricted letter of credit. A letter of credit where there is a no recourse available against the exporter is a without recourse, and the recourse is available is a with recourse. So these are all different type of letter of credits. Okay. Wow. I think I'm done. Do I have a 10 minutes, 15 minutes time, or can I continue, or shall we stop?
Continue, sir, please.
No, I think.
Sir, please.
Biju.
Yes, sir. Yes, sir. You can, sir.
Okay.
Yes, sir. Yes, sir. Some are saying, sir, need to go to office.
Oh, yeah. I know. Now only 4 slides or 5 slides are there. I think I
friends,
can.
please wait for that.
Only 5 slides are there. Don't worry.
Sir, yes, sir.
And those who are missing also, because now I am starting a very important topic, which is a capital adequacy, Basel 2, Basel 3. I think people may be wanting it. Okay. I wish that people must attend it, because tomorrow there may not be time available for us. Because tomorrow I'm planning to have some MCQs also based on the module A and module B. Okay, so please make a note that bank is a business of risk, and the risks are different, and those risks are the credit risk, market risk, and operational risk. Credit risk is a risk relating to loan, inability of customer to make the payment, whatever loan we have given, that loan repayment in full or a part on time. If it is not paid, then it is a credit risk. And risk due to any change in the interest rate or change in the price of a particular security, that is a market risk. and this market risk may happen on the trading book or a banking book. Okay, market risk has got that. Operational risk is any risk due to the failure of people, failure of process, failure of system, failure of external events. That is the operational risk. These are the three key risks identified by the BCBS, Basel Committee on Banking Supervision, for the purpose of capital requirement. Okay, so these are the risks. And why someone takes the risk? Because banks need to take the risk. Without risk, there is no profit. Risk need to be taken, and therefore bank must have ability to identify what risk they have taken, how much risk they have taken, and whether the risk is manageable and whether the risk is controlled properly. Okay, that is what is a risk management is all about. Okay, so next is Basel 1, Basel 2, Basel 3. People talk about Basel. Basel is nothing but a place. Okay, BCBS is a Basel Committee on Banking Supervision. Basel Committee on Banking Supervision. Basel is a place where Banks for International Settlement is located. Banks for International Settlement is representing the all countries' central bank. Okay, all countries' central bank guidelines are being given by Banks for International Settlement, which is located in Switzerland at Basel. Okay, then that particular bank's Basel Committee on Banking Supervision has suggested some guidelines regarding requirement of capital, requirement of some guidelines in order to manage the risk, and that committee's recommendations are known as Basel Committee recommendations, Basel 1, Basel 2, Basel 3. Since Basel 1 is now redundant and gone, I am not using it, but BCBS first time started in 1998. Okay, 1998 onwards, the Basel Committee started functioning. Okay, now sorry, not even 1998. I think 1988 onwards. 1991, first time the guidelines started implementing in all other banks, and first time in our country also. Narsimham Committee's first set of recommendations are outcome of the Basel 1 only. And at that time, Basel 1 was taking care of only the credit risk, whereas Basel 1 and Basel 2 in between, in 1998, the market risk also was added. Whereas Basel 2 started taking into account all the three risks, that is credit risk, market risk, and operational risk. And Basel 2 has got three important pillars: minimum capital requirement, how the supervisor, that is Reserve Bank of India, all the disclosures bank need to make with regard to their balance sheet. This is what three-pillared approach is adopted in Basel 2. And this Basel 2 approach, credit risk is managed through a standard approach. What is the standard approach? That there are risk weights are assigned to a particular assets which are appearing on the balance sheet, and against that particular assets, the risk weight which is assigned gets multiplied, and risk weighted assets are arrived at. Against those risk weighted assets, there must be a capital requirement. Same way for operational risk, the approach is a basic indicator approach. Basic indicator approach is a set percentage. For example, 15% of gross profit. 15% of gross profit earned during last 3 years average is considered as basic indicator, and that 15% of the gross profit is considered as a basic indicator, and that much amount is considered as a amount of risk weighted assets on operational risk. Similarly, on the market risk, duration method, and accordingly market risks are also calculated, and all the way risk weights are calculated on all the three, and against these risk weights, amount of capital that is required is 9%, 9.5%, 11.5%, whatever that 0.11% is nothing but that much of percentage of capital against risk weighted assets of credit risk, operational risk, and market risk. Okay, so this is what is a risk-weighted assets. A risk-weighted assets capital is calculated on two counts: Tier 1 capital and Tier 2 capital. In between, there was a Tier 3 capital, but Basel 3 has removed all the three capitals need to start a bank, sir. Okay, no problem. Okay. Tier 1 capital and Tier 2 capital. Generally, which are all the items are taken into Tier 1 and Tier 2 capital? Generally, here are only in a condensed way I am showing share capital, the reserves which are disclosed, and any sort of capital gains which otherwise were tied to capital, but Reserve Bank of India and Basel allowed us to take into account the Tier 1. Whereas Tier 2 is a supplementary capital which is available in the form of hidden reserves, that is excess provision made, additional provision made more than requirement, or provisions for losses on loan. All those reserves are in Tier 2. In addition to this, there are some instruments which where people have invested money. That also is either Tier 1 and Tier 2 depending upon its nature. Depending upon its nature. To be precise for exam, here is a point which is included in Tier 1, which is included in Tier 2. Say paid up capital, share premium, statutory reserve, capital reserves, disclosed reserves, any revaluation reserves at a discount of 55%, any profit and loss account balance, all this is taken into account a common equity 1, that is a Tier 1. In addition to this, the additional Tier 1 capital also allowed in the form of perpetual non-cumulative preference shares, perpetual debt capital instruments. These are also allowed as an additional Tier 1 capital. So this is the Tier 1 capital. In addition to this, which are all the parts which are Tier 2 capital? Tier 2 capital are general provisions on standard assets. What is the provision on standard assets? Can anyone tell me quickly? Provision on standard asset is 0.25% to 0.40%. Am I right? 1%, 2%. Okay. So likewise, different commercial real estate, 1%, 2%, isn't it? Commercial real estate, 2%. So likewise, different reserves are there. Those are here. Provisions held for country exposure, investment reserve, all these are Tier 2. So this is what is a Tier 1 and a Tier 2 requirement. Okay. Then here is an important slide for exam. I think here this slide you need to mug it up. Remember, because exam point of view, very, very important slide. Minimum common Tier equity required is 5.5. Additional Tier 1 maximum allowed is 1.5. So put together, total Tier 1 capital is required at minimum 7%. Minimum 7%, of which maximum allowed is only additional tier. Whereas this 5.5 can be increased to any amount. That is no problem. In addition to this, you can see the Tier 2 capital. Tier 2 capital is maximum 2%. Maximum 2% of what? Risk-weighted assets. Risk-weighted assets. So this 7 plus 2, how much it is? 9%. 9%. Though the Basel says 8%, our Reserve Bank of India says 7 plus 2, 9%. Whereas in addition to this 9, additional requirement is capital conservation buffer of 2.5%. So 9 plus 2.5% is 11.5% is the minimum total capital ratio. In addition to this, the counter-cyclical buffer is an additional requirement which is yet to implement in our bank. Okay. So this is what is a capital requirement in our country. Okay. Whereas domestically, systemically important banks, as I already told you, 0.60% extra. And for HDFC, 0.20% extra is required to be made. Okay. Very important slide for exam. You can make a note of it. There are two more ratios are prescribed in Basel, and those are the Lcr and Nsfr. Since you are for Jaiib, you are expected to only remember the expansion. Lcr is nothing but liquidity coverage ratio. Nsfr is nothing but net stable funding ratio. Net stable funding ratio. So there are 4 credit rating companies: TransUnion, CIBIL, Equifax, Crifimark, Experian. These are the credit rating agencies, and these people can take membership. Banks are members of it, and credit rating companies are CRISIL, India Rating, ICRA, CARE, Brickwork. These are Reserve Bank of India approved credit rating agencies. Credit rating agencies. Okay. I think we are almost done with. We have always done it. And this alliance and merger, our marketing person might have told you. So I need not have to spend time on that. Thank you so much. Any questions are there, you may reserve, you may ask. I'm open for questions, and I also am open for any feedback on today's session. I would love to have it.
Yes, friends, please come out with your feedbacks.
Feedback as well as any questions if you have anything. Okay, no problem.
Sir, Camel Rating, sir.
Camel rating. Good question. Okay. Camel's rating is a rating given by our Reserve Bank of India with regard to bank. And that is CAMELS. Okay. CAMELS. CA is capital adequacy. C is capital adequacy. A is asset quality. M is management. E is earnings. L is liquidity. And S is systems and procedures. Camel's rating. Based on these 6 parameters, bank is getting rated. Okay.
So one more time.
Capital adequacy. C for capital adequacy. A for asset quality. M for management. E for earnings. L for liquidity. And S for systems and procedures.
So shall we get the record class in the group?
I think he will post it. He will post it. Don't worry. Biju will post immediately, and this is a live class is going on our YouTube. So YouTube also this is available. You can visit the YouTube channel, and you can watch it. And I wish that you must visit my channel also. Almost all these topics are there in that.
Can you please PPT, sir?
Here it is there on the title. You can see on the screen it is appearing. P2G banking. You type. You get that. Most of the lectures are available there. You can leisurely listen those lectures on a different topics. Okay. And very useful session for examination. Please provide PPT. Yeah, definitely. Tomorrow I'll be.
Sir, can we get PPT?
Tomorrow itself is the exam, sir.
Tomorrow
Is it?
Tomorrow is exam, sir. So you can share now, sir.
Okay. No problem. I'll try.
Yes,
managing.
sir. Principal exam
I'll try
tomorrow,
both.
sir.
I'll send you both the PPTs today. Say that session, this session as well as today evening session. Okay.
Thank you, sir. Thank you.
Don't worry. Okay.
Thank you, sir. Thank you so much, sir.
Good
Sir,
luck. Good
if
luck to you.
possible, share the PPT now, sir. So we
I'll. For me, it is night 10 o'clock.
Sir, speaking from
International
USA.
session it is. Okay. Nice. Okay,
International
I did
session.
not receive a feedback. How the session was felt.
Please
very
come
good,
up with your
sir.
feedbacks.
Sir, very good, sir.
Was very useful, sir.
Excellent, sir. Thank you.
Very brilliant.
Okay.
Okay.
I'll share it. Now itself, without closing, I'll just quit and I'll share the presentation on our WhatsApp. Okay.
Thank
WhatsApp,
you very much, sir.
Biju, I'll share it to you. You share it on different groups. I don't know.
Yeah, sure, sir.
Okay.
Thank you very much, sir.
Okay. Bye.
Thank you.
Bye.
Thank you so much, sir.
My pleasure.
Thank you, sir.
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 Bye.
Thank you.
Thank you.
sir.
Thank you. Good day to you.
Good night, sir.
Thank you, sir.
Thank you for your feedback.
Very good night. Thank you.
sir.
Thank you.
Today evening 7:30, all please join for continuation of this class.